We are live. Um, so I guess, Justin, you're not quite up to prestige. I guess, do you have anything that you want to talk about or ask Dr. Jones specifically?
Yeah, I was just on Tokyo and feel pretty good about it. But just on the fourth question, I don't know how specific we can get, but um, on it, as far as looking back and comparing it to prior years, I was looking over the whole 5 year period, not just looking at this was from '96 to 2000, and as far as whether there was a gain or loss, I was looking, hey, this thing they got it in '96. Here we are in 2000, so I was looking at the whole 5 year period. I didn't know if I should just be looking to '99 or if we should go back to when we started in '96.
For Tokyo, that's the Tokyo case, right?
Yeah, the last one, number 4 on the marketable securities.
Let me call that up. I remember the question. Basically, I really just want kind of discussion that you illustrate an understanding of marketable securities. As far as the
Okay.
years going back, I'm not too sure. Let me call that up real quick.
Because I put in there the type, how I would handle them as what type of security, and I got all that covered, and I just didn't know how deep you wanted to go with it, but I was looking at whether or not there were gains or losses, because that's a part of it as well. And then I started looking back, okay, do I take this all the way back to '96 and talk about gains and losses for that whole period, or are we just really not even needing to go there?
Yeah, no, I'm looking back. Yeah, I'm really not caring that you do all that. The main thing is just that you understand what the proper accounting would be.
Okay.
Whether just to illustrate an understanding of how to deal with marketable securities, basically.
Okay. Gotcha.
Yeah, so you can be, actually, I think you can be pretty general. If you want to go into more specifics, that obviously doesn't hurt anything, but that's up to you.
Okay.
Yeah.
Appreciate it.
Not very, honestly, not very different from the probably even less detail than you were required to go back through in what was that, assignment 4?
Yeah.
Yeah, because they're
The
they're actually wanted gains, gains, losses, those type of things. But here, yeah,
But
I mean,
you're not looking for it
if you
here.
don't give a number, I'm fine.
Okay. Gotcha.
Is that all you got, Justin?
Yeah, that's all I had on Tokyo. I'm good. Appreciate it.
All right. Erica, how about yourself? Or are you just being that silent listener tonight? I think somebody else dialed in too. I am trying to unmute. I can unmute you. Hold on a second. Try now.
Okay, can you hear me?
Sure can.
Yeah.
Okay, perfect. I was struggling there. I do have a question, and I feel foolish for asking this, but I want to make sure that I understand the question on the Tokyo case. For question number 3, you're asking for the accounting treatment. Are you talking about, like, just as an example, like FIFO or LIFO, something like that, or am I not reading this question properly?
Yeah, no. Basically, no. You're right. How would you account for the expected losses? I mean, you have loss. Do you? Yeah, FIFO, LIFO would be a good example because that doesn't. You're not doing inventory accounting here. But yeah, just you don't even have to explain like a certain necessarily method as much as there's an uncertainty. There's an inherent uncertainty with an expected loss. So whether it was a automobile contract or a catastrophe, so how would you do that? I mean, what is if you have? I mean, put yourself in an insurance company kind of perspective. There's these losses that may or may not occur in the future. What would you do? Should they be accounted for? If you do account for them, how would you do that?
I think we just lost her actually.
Oh, that's bad. I just saw her disappear.
Yep. 2000 back in. Who's at the 770 number? Is that you, Justin?
No, this is Shanavius.
Hey, Schnatters, how are you, man?
No.
Do you have any questions for Dr. Jones while Erica dialed back in?
Well, mainly for the Tokyo one, just lend core expectations. Because I mean, I had roughly a page, just kind of short answer questions. Were you expecting numbers, or is that okay?
I missed a little bit of that. Did you say? I think just like expectations. Is that really the kind of the question?
Yeah, yes, sir.
Yeah, I mean, I'm not really. I mean, as far as numbers, not necessarily. I mean, you don't have to have a lot of numbers. It's kind of again more like a kind of final exam. You've got the first question, talking about revenue recognition. How should you do that? I mean, I'm not really looking for an exact number there as much as when, it's really a timing issue. When do you recognize the revenue? When would you recognize the revenue on that insurance contract? So, I think I would answer that with words. The
Right.
second question, is the kind of capitalized expense discussion sort of like what we had, what was that? I think in the fourth assignment, I believe, very similar to the question that we had in assignment 4 with, um, what was that? The subscriber acquisition cost. Very similar, something like that. Do you capitalize? Do you expense? What do you do? Again, not subscriber acquisition cost, but again, it gets more into that idea of do you understand? I guess the first question is really do you understand revenue recognition, kind of in general. Second question, do you understand really expense recognition versus capitalizing? You're spending money. It's either going to be an expense or an asset. So just kind of do you understand, those, so if you say it's an expense, do you understand expense recognition? If you say it should be capitalized, do you understand kind of the criteria to say, hey, we're going to call this an asset? So again,
Right.
I don't think numbers are necessarily required there. The third one, again, no numbers there. That's more just a do we understand that you had this future liability, so we've dealt with revenues, possibly expenses, assets. Kind of the third question is dealing with liabilities. Should you recognize a liability? If so, when should you recognize that? And then the last one dealing with like marketable securities, again, not necessarily numbers. So yeah, I mean it's really, I'm not really expecting numbers as much as just demonstrating an understanding of those ideas, concepts, looking more really, I mean, quite honestly, looking more to the fact that do you do you really understand? Okay, I guess more thought of how you understand how you would apply that situation, not necessarily I must give this number. I must quote something. It's just more independent thought, like I've been talking about. I want to see what you think about how you should recognize revenue for an insurance contract, how you should recognize potential liabilities, investments, those type of things.
No. So I'm with you on that piece. I was more so concerned with. So I like the KISS method, right? Keep it simple. But sometimes I'm too simple or too straightforward. I'm like, am I missing an opportunity for bonus points if I misunderstood something? Should I make this a little bit longer for full credit? That was my thing, like lengthwise.
Yeah, I mean, well, obviously, I mean, from a selfish standpoint, I'm reading them all up. I'm going to read all these. I'm going to grade them all. If you make it short, concise, to the point,
Do you get
that
bonus points for
definitely.
that?
Yeah, I mean, you know what? I mean, it makes me happy. But I mean, obviously, I want you to give a complete answer of what you think about revenue recognition. If you throw everything in the kitchen sink, it looks like that. You know what I'm saying? I mean, so it's a mix of what do you think? I mean, answer the question. If I'm asking to how would you recognize revenue in an insurance contract? Don't just say I'm going to recognize insurance. I'm going to recognize the revenue. I mean, really, you got a couple choices, right? I mean, I don't think I'm giving away an answer here because I'm not going to tell you what I think the right answer would be. But you're either going to recognize revenue when you sign the contract, when you get paid, over time. I mean, you can say recognize revenue when you sign the contract, but what I'm really looking for is the why.
Right.
Recognize revenue when blank for this insurance contract, but why do you want to recognize the revenue at that point in time? That's really, I'm going to be looking at the why. So, I mean, if you throw everything in the kitchen sink, you might go, well, I would recognize it here or here or here. Then I'm like, okay, then you're really not answering anything because you just given me three alternatives and never really told me which one you picked.
Right. No, I got you.
So it's the why. So yeah, pick an option, pick why you pick the option, and I think you'll be fine. If the why's missing and that independent thought is missing, that's when you have problems.
Gotcha.
Awesome. Eric, are you
Hey,
back
it's
by chance?
Erica. I'm sorry, I'm back. I don't know what happened.
No problem. How much of my answer did you catch before you got off there?
Like the first 4 words.
Okay, perfect. That's fine. No, so yeah, you were asking about the third question, which is really dealing with the liability side. You have these possible catastrophe, the possible catastrophes that could happen. One I think was an automobile contract, one was a catastrophe. And so when you're faced with a situation like that, what should you do? There's a potential liability out there. What should you do? Will you recognize the liability? Will you not recognize the liability? Will you wait till it occurs? Will you recognize it before it occurs? And again, like I was just saying on to the previous answer, or in the previous answer, it's the why. It's the why that I'm really looking for. I would recognize an answer why because that's really what I'm looking at. That you can support what you would do. Whether you're exactly right or not, support it with some of those accounting concepts that we discussed.
Okay. I think I was just a little bit thrown off by the wording. I was thinking that there was some specific kind of accounting procedure, if you will, that I needed to list it as, and not necessarily like how I would put it on.
Yeah, I mean, not anything like you mentioned, not like FIFO, LIFO necessarily, but I mean, I think as you start explaining the why and you draw back to some of the lectures that we've had, there'll be some, go back and look at. I mean, this is more dealing. I mean, obviously, you're not going to account for, we're dealing with like liabilities here, so I'd say go back and look at like assignment 5. And look at what we were asking you to do there and see if any of that stuff sort of fits and the reasoning behind that, and then apply it to this case. Because that's really where we were talking about liabilities in that last assignment that we had.
Okay, got it.
Who else got something? I see Tara joined us.
Terry, you're a good moderator. Let me say that.
I'm going to take Tara off mute just so in case she's talking to kids, we can embarrass her a little bit. Tara, are you there? Okay. I have, and it's been a week, so I'm going to apologize since I've actually looked at this. I was trying to get ahead. I listened to all of lecture 6 and went to start the prestige case, and literally I was unable to. And maybe I just need to go back and look at the videos, Dr. Jones. But if I look at the first question, I can kind of talk about the history of the case, but as far as getting into how I would set up the accounting for it. I got stuck a little bit, and
okay. Let me say one thing. Let me go back to one thing. One, Tokyo. If any of you guys are still working on Tokyo, again, some of y'all were, that's fine. Go ahead and submit. I will not download those probably until like Thursday. I just won't get a chance to work on them tomorrow. And so I probably won't download. I have not downloaded any yet because I was fighting fires the last 2 days just trying to get back from all the things that happened. And so I will download those probably the end of this week, so maybe Thursday. So if you haven't done anything for Tokyo, that's fine. You can change stuff if you want to change anything. No need. I'll just download Thursday. If you upload it after Thursday, then let me know so that I'll be grading the proper one. As far as prestige, again, I won't be getting on those until they're due. Gosh, I'm not even sure when they're due. That's not due for almost another week or so, isn't it?
Correct.
Yeah. So I won't be looking at those for a while. But when you start on that one, this is one. I see you got that up. Can you page? Did I give you questions for this one, or were they included in the case?
They're included in here. Yeah. So the first question really is appraise the operations. Is it really a problem to the parent? And talk about the differences.
Yeah, the first question, I mean, the meat is really not till you get to question 3. First question, strict opinion question. I mean, they've given you a case. They tell you about prestige data. We tell you about, a subsidiary of the telephone. So you've got data and you've got the phone company, and then you're trying to say, is it really a problem? Because when you read through the case, it looks like, hey, there's some problems going on here. Is this really a problem or is it not? And I just really want you to look at the cost that are reported versus the ones that are really relevant for the decision of, do we continue with data? Do we get rid of data? I mean, there's some legitimate questions here. So it's strictly an opinion question.
But then there's the why behind that, right?
But there's the why behind it, and and it's the why behind it. So if you think it's a problem, tell me why it's a problem. If you don't think it's a problem, tell me why you don't think it's a problem. Now, my advice to you as you approach this, I probably wouldn't do question number 1 first. Okay. I mean, come up with an answer, come up with your initial thoughts, jot them down real quick. Don't necessarily do question 1 first, okay? Then you'll look at question 2, and it's talking about, basically break even, right? I just want you to calculate a break even point. Well, if you go back into that, I say to the end of lecture 6, but the back part where we started applying stuff on lecture 6, we started talking about CVP analysis.
Right.
We go through all that. That's where we calculate break even. So when we start talking about CVP there, that's where we talk about cost, volume, profit. That gives you some questions it'll answer. And we'll stop right there where you are, actually, Terry. That'd be great. When you look at, or go back just a little bit more.
This equation is important for the next assignment. I highlighted that
equation. Yeah. Here's the deal. I'm telling the 7 of you guys that are on here, I'll tell you, when you turn in a paper and you haven't looked either at that equation or listened to this part of the lecture, this equation is important and perfect. If you haven't looked at that, which there'll be probably 1 or 2 people, I'll go, okay, y'all went really fast to this lecture. Y'all did it while y'all were exercising, or there was something y'all just weren't really paying close attention to. Because I'm telling you right there how to calculate that X is going to be your break-even point.
Fixed cost plus income divided by
contribution margin.
CM equals contribution margin.
Yeah, and so we'll talk. And contribution margin, you can see right up there is your revenue minus your variable cost per unit. So it's just, kind of derived how you got that CM right above it.
Where is that at? I'm sorry.
Right there where your cursor is. The revenue per unit minus the variable cost per unit. I'm doing a little math there.
Yeah.
I started with, revenues minus variable cost minus fixed cost equals income. Then I broke it down to, look at it on a per unit basis. Take the revenue per unit times the number of units. That's total revenue. Variable cost per unit times X number of units. That's variable cost. So I'm kind of breaking that down on a per unit basis. Then I did a little math, isolated the X, moved that out.
So what does X stand for again?
I'm sorry?
What does X stand for?
X is the number of units. X is the number of units.
Okay.
Right. So there's your volume. I mean, there's some volume that's driving this activity. If you're selling something for, $10 a unit, your revenue per unit is $10. You sell 10 of them, that's $100. What's your variable cost per unit? Whatever it is, it's $5. You sell 10 of them, that's $50. So your contribution margin is on a per unit basis, 10 minus 5. Probably a bad example since the answer is 5. But you said take your revenue per unit, your variable cost per unit, and that tells you what your contribution is. What do you have left to cover fixed cost, right? Yeah. And to earn a profit.
Yeah.
In this case, if you're trying to reach break even, which is slide down just a little bit on those slides if you can. This is where we start. We talk about operating leverage. This is the never mind. I remember where I am. We actually did a break-even problem. So if you come down
here, yeah,
right up in here, those are see. That's where I'm talking about cost in general. But right after I introduced that equation, it's not on the slides, but it's on. When you watch the video, we worked through it with a little blue sheet of paper.
Yeah, and I put in one of those in here. I didn't copy it in here, but
yeah. So it's where we talk about, so once I introduce that equation, I actually walk through, I think there's a whole section in there that's missing on the slides because I just didn't, it was easier to draw it out than actually do all that. But we actually walk through how to apply that, how to calculate break even, how to do all that. So if you'll come back to the case, In the second question, I ask you to calculate break even. So that should be, I mean, if you miss number 2, I'm giving you everything you need there. I'm saying, hey, assuming demand is going to be 205. Hold on a second. Let me see something.
So can I ask you a question?
Actually, don't use these questions, Jerry. Yeah, this is what I was thinking about. Don't use those questions. Hold on, let me open this up real quick. If you look, I'm pretty sure I supplied these, but I just want to check. If we go to Canvas, which is what I'm doing right now, I'm probably going to have to do that Duo authentication stuff because all you technology people make me go through too much crap to plug in stuff.
I got some handouts right here. Was this what you're looking for? Either common cost, Tiger, or CVP analysis?
Yeah, no. Hold on one second. I'm in my thing now. I just want to make sure it is on Canvas because it should be right there. So when I go to the modules for lecture 6, you know what? It is not there, I don't think. Hold on one second. It's supposed to be there. Yeah, no, it's there. Yeah, when you go, I probably could make it easier to see, but this is really big. If you will go, can I share my screen?
You sure can, or I can go to Canvas, one of two.
No, here you go. Let me see if I can share this right now.
All right, I'll stop sharing.
Oh, sharing controls are disabled by pop. Yeah.
Here, I'll make you a presenter. Boom. You're good to go.
All right, so let me share this. Okay.
We'll make you a computer guy by the end of the semester.
Exactly. Okay, so I'm now presenting primary monitor. Nothing's showing up. I may turn it back to you. Can y'all see that?
It's coming. Give me a sec. Give it a second.
Okay.
Yeah, there we go.
See Prestige Telephone. So what I did, let me back out of this. So I'm just in the modules. And when I come down to lecture 6 and click on Prestige Telephone, you can you see that you can download the case, use the following questions. And if you look, these questions are going to be a little different, slightly different than the ones there. First question is the same, evaluate the results, a strict opinion. But then my second question, briefly analyze the cost behavior. That's where I'm like, do you think most of the costs are fixed? Do you think most of the costs are variable? But then look what I do in the third question. Third question is I'm going to ask you, come here, I'm going to ask you, say, hey, let's make some assumptions. We have a $28 per hour variable cost. We have revenue of $800 an hour. So you can calculate contribution margin because now you know the per hour cost, the per hour revenue and the per hour variable cost. I give you fixed cost. Your actual utilization, I assume 138 hours. I'm saying that's how many hours you're actually working, which is the same one for March. So I'm not really worried about that kind of thing. What's the break-even volume? Go back to that equation you were talking about. You have your contribution margin, you have your fixed cost, your income is 0 at the break-even point. So that should be a relatively straightforward calculation to calculate break-even.
Mm-hmm.
Okay, given that equation that we had up a second ago. Then you turn back around and we go, now it gets a little harder. And again, what I would do is kind of form an opinion on number 1. Let me go back. Form an opinion on number 1, but don't spend a lot of time. But just kind of tell me, is it a problem? Is it not? Kind of think of an answer. Look at the cost. Look at the revenues and expenses for Prestige data that are given. Again, this is a relatively short answer. Do you think most are variable? Do you think most are fixed? Which ones do you think are variable? Which ones do you think are fixed or mixed or step or, any of those 4 different types of cost behavior that we talk about? Again, that shouldn't take you too long to do number 2. The meat of the thing is number 3. So number 3, I'm going to say, hey, let's break even. Okay? The 138 is kind of meaningless at this point. Okay? But use this information right here. What's the break even volume in hour? What's the break even volume? How many hours do I need to break even? And you're going to get a break-even point, and obviously Prestige data is operating at a loss, So the break-even point needs to be above 138 hours, or else they'd be breaking even, and they're obviously earning a loss, so they're not at that. They're not using enough hours to break even yet. Okay. Then, if you'll notice these next 4 scenarios here, in Part B, these next 4 scenarios get a little increasingly harder, but these next 4 scenarios apply that CVP analysis and apply that knowledge of cost behavior that we talk about in Chapter 6. All those ideas and concepts are now starting to come together. So now I'm going to say you can basically take that exact same equation that you use to get a break-even point, and then I'm going to say, well, what if we increase the price? Well, if we increase the price to $1,000, I should say per hour. My English isn't good, but if we increase the price to $1,000 per hour, demand falls by 30. Right? Price goes up, demand falls.
Yep.
Economics. Well, if demand falls, well, the demand's not going to be 138 hours. So these are all the strategies that are discussed in the case. Hey, let's increase our price. Well, yeah, if you increase price, then your contribution margin's higher, right? $1,000 minus 28 is a higher contribution than 800 minus 28. So your contribution goes up, but then your demand falls. So now you're not going to be working as many hours, right? So what's going to happen at that point? You won't be working 138 hours. Your demand's going to fall by 30%. Well, now can I apply that same CVP, which is really what if analysis? Well, I know my break-even point is so many hours, X hours. Let's just call it, I'm going to make up a number here because I know it's not right. Let's say break-even is now 200 hours. Well, I need to do 200 hours to break even if everything stays the same. Well, if I increase my revenue to $1,000 an hour, that's great. My contribution goes up, but my demand falls. Will I break even? Will I earn profit? Will I earn less of a, what's going to be my income effects? Is my income going to go up? Is my income going to go down? Next thing is, well, what if we reduce the price? Well, if you reduce the price, you'll earn less in terms of contribution. 600 minus 28 is less than 800 minus 28. But you're going to sell more because lower price, more people will want your service. So just really the opposite effect. And so now it's not going to be 138 hours. It's going to be 30% more than 138. So now you're playing what if. I know at 138 hours, this is how much profit I have. And again, ignore the intercompany stuff. Just ignore intercompany because that just complicates the whole mess.
Okay.
So at 138 hours, this is a 28 hour, 800 of revenue, 28 of that of variable cost, 115, 820. What's going to be my what's my break even at that? Well, I'm below break even. Well, if I change these items, comparing it to my base scenario at 138 hours, will I now be earning a profit if I increase my price? Will I be earning a profit if I reduce my price? What if I reduce my operations to 16 hours on weekdays and 8 hours on Saturdays? So what if I use less hours? Well, if I do that, I'm going to lose some revenue hours because I can't, I don't have as many hours to work. What will that do to profit? And again, all we're doing in each one of those scenarios, we are simply, we're really taking that base case of what am I earning based on $28 an hour, 800. What am I earning based on this base case?
So you're essentially ignoring everything that's in Exhibit 2 from 3 on down.
Yeah, there's really no need. I mean, Exhibit 2 was an analysis there, and that's fine. But yeah, use this scenario.
Okay.
And then say, at that scenario, what if this happens, this happens, this happens, which are all the little things they suggested. And so this is allowing you to say, well, we can always do stuff like in general in business, right? We'll go, well, hey, we'll increase the price, and that way we'll earn a profit now because at 138 hours, maybe we can earn a profit. Yeah, but if you increase the price, demand falls. Oh, yeah. Well, how much would demand fall? Whether you're earning a profit depends. Does the increased profit you have from increasing the price, does that increased contribution, is that offset by the demand, by the loss of demand? Well, if my profit, if the contribution I gained is bigger than the loss in demand, then I'm better off. But otherwise, but if my demand falls by more than the extra contribution I have, then I'm worse off. I don't know till I run the numbers,
Yeah.
right? So increasing the price to 1,000, reducing demand by 30 may be good. It may be bad. I don't know. I don't know. But this is, so what I would do if I were really in business, right? Somebody go, hey, what if we increase the price? I go, okay, what do you think would happen to demand? And then our people that are selling our product would go, well, there's going to be people that just stop using us. I bet our demand falls by 30%. So the people with that knowledge will tell us, we go ask, well, what's going to happen to demand? They'll tell us. We'll go, okay, maybe that's good, maybe that's bad. Well, next option, what if we reduce the price? Well, hey, demand's going to go up. Okay, by how much? The people that are in the best, the people that have the best knowledge, the people where that knowledge resides that would be able to tell you its demand, get input from them. Then we can plug it into our accounting equation and actually be able to put a number to that. So I can say, hey, I think reducing the price will increase demand. Hey, that sounds like a good thing because more people are using our stuff. But now we're not, we're making less money per every hour. So now I'm going to have, with making less money per hour, I hope I make enough extra hours to be able to overcome that. And again, and you can do each one of these. Then you get down to the fourth one, and really we're just doing what if. Well, what if this happens? Well, what if this happens? Can we actually put a number to it? Then the last question, if you look the Roman numeral 4, if increased promotion, I mean, that's the other thing. Well, what if we don't do any of that? We just put more in the marketing budget. Well, if we, if the marketing people do their job and they market better, then sales will go up. Okay, true, but how much? If I go spend $100,000 on marketing to increase sales by $20,000, well, that's kind of stupid because I've just lost 80, right?
Mm-hmm.
So how much can I spend without reducing my income? So you can actually, what I'm going to show you here is if you take that analysis of like, well, this is my baseline. If demand goes up by 30%, what's its cost, volume, profit? What's the predictable effect on profit? What's going to happen by my understanding of cost structure, revenues, variable cost? What's going to happen? Demand's going to go up. What's going to happen to profit? How much do I expect profit to go up? And if I tell you, hey, I expect profit to go up by $50,000 if sales increase by 30%, well, that tells you if I spend $50,000 on marketing to get a $50,000 increase in sales, then my income will be exactly the same. So if I can do a marketing budget of something less than $50,000, say let's throw out a marketing budget of 40, and I increase sales by 50, then I'm 10,000 better off. If I do a marketing, but if I can spend 30,000 to increase sales by 50, you see the idea? So like that fourth question the questions get increasingly difficult. Break even's pretty easy. As you get down to Roman numeral 1, 2, 3, 4, they increase in difficulty. And the last one is not using CVP to tell you what profit is, but to help you set a marketing budget. I know that. What do I think will happen? Increased marketing, it's kind of a scale there, right? You spend more money on marketing, maybe you get an initial hit. If we keep spending money, then maybe the additional sales kind of level off and that slope kind of levels out. Well, how much can I spend every month? And that kind of can maybe give you an upper end on what you think you would spend on marketing. And then maybe you go, well, do I want to spend $50,000 to get $50,000 increase in profit? Well, I might as if I'm going to be in the exact same position, then let's just not spend the money, right? I mean, why spend the money to be in the exact same position unless you're going for market share or something like that?
Right, because then once you have the customer, then obviously you don't need to spend the marketing the next month or the next year, right? So.
Exactly. But so this is just trying to give you an idea. I think if I do marketing, I think my marketing people say, hey, more marketing could increase sales by 30%. I'm like, okay, well, how much can I spend on that marketing? Well, if you know the effect of an increase in sales by 30%, how much will that affect profit? That kind of gives you an upper bound to how much you can spend on marketing and not be worse off. And so that gives you kind of an idea there. And I have a feeling, since with this case, if you'll work through really, if you'll kind of analyze cost behavior, do you have a lot of fixed cost, a lot of variable cost? And again, look at question 3. 3 kind of gives you a hint. If I have fixed cost of $115,820, my variable costs are only $28 an hour.
Yep.
My revenue is $800. I can kind of look at question 3 and go, man, I'm probably got a lot more. I have a lot more fixed cost in my capital structure than variable.
Yep.
Right. So, but look at those costs and tell me what you think. Just looking at them, can you see them? And there's where you can look at information in those exhibits. And if you see, hey, when volume goes up, cost goes up. When volume goes down, cost goes down. Well, if that's the case, then you have a if that's the case, then what you end up having is a a cost that has some variable component to it. If costs remain relatively flat as volume levels change, then that's more of a fixed cost. Right. So, but the key is use these questions. Use the questions that you get when you click on Prestige, in the assignment, not the questions with the case.
Which was worth having this entire conversation.
That is worth having the entire discussion. So I am actually, as we're talking, I'm going to turn it back over to you, and I'm going to post an announcement. If I can figure out.
I'll take over. Go ahead.
Can you do that on your own?
Yep.
I don't know how. Yeah, take back over, and then I'm going to come back in here once you do that, and I'm going to actually post an announcement that says, for Prestige, use the questions that when you click on that, not the questions in the case.
Yeah.
And if you could, Terry, can you pull those questions in the case up real quick?
Yeah, give me a second.
If you look at them, the questions are very, very similar.
Yeah.
But what you really have to do, if you look at these questions, assuming demand will average 205, what do you need to break even? Well, for me to be able to do that, I've got to come up with what I think fixed costs are, or what I think variable cost per unit is. And if we were sitting in class, what I would do is I would sit here, do something like what you're doing there, right? I would come out. So what you have on the spreadsheet is essentially your answer to question number 2.
Okay, so I don't want to try and give away the answer, but since it's not relative to number 3, but it's
not critical. Yeah, don't flash up your break even. But if you do something like this, I mean, you've broken out your costs, you've seen how much they vary. Hey, is this relatively fixed? Is it relatively variable? And just try to make an assessment. But what you would have to do if you were actually answering the questions in the case, you'd have to take an analysis like this. You'd have to figure out what you think your fixed and variable costs are. You'd really have to come up with a cost model. I did in question 3 was give you fixed costs, give you variable costs.
It just the whole case just got much easier for me.
Yeah, oh no, it does. No, and that's why I did those questions, because otherwise, if we were in a real class, we'd have this discussion. We'd spend 30 minutes. We'd come up with fixed. We'd come up with variable. And honestly, I think my hours that I came up with, they're not. If you ignore the intercompany stuff, it's not far off of what I would get if I did an analysis like this.
So just if we were having this conversation in class, I'm curious, given the fact that some of these are fixed costs to the parent, like the rent, custodial services, the corp services, does that make any difference in the cost model? Not really.
Necessarily make a difference in the model for when you're looking at break even. It could influence your answer to the question.
Correct.
Is Prestige really a problem? Is the data really a problem for phone?
Right.
Right? Because if the cost, and this is because if you go back, it's really wanting you to focus on relevant cost.
Yeah.
If the cost is fixed to the parent, and you say, I'm going to eliminate Prestige, I'm going to eliminate data, because data's running a loss, right? Or you can see down there at the bottom, right? They have a net loss, 41, 40, 21. It's getting smaller. That's good. But, I mean, and that can all go into your answer. Is it really a problem? How big of a problem is it? That can all go into there. But I'm not going to give you any more than this. But think about this. If the cost is fixed to the parent and we say data is a problem and we eliminate data, does the cost go away?
No.
I won't answer that question. But if the cost doesn't go away, if we eliminate data, then is it really a relevant cost in trying to decide if data is a problem?
Right.
You say so we'll leave it at that.
Yeah.
But so when you go back in, and that's why I was saying kind of skim through the first one, but go in and look at the cost. And when you find that some costs are fixed, some costs are variable, some costs are there, even if data ceases to exist, you're still going to have, like, look at your rent, right? You're still going to have 8,000, 8,000, 8,000 custodial services. You're still going to have a lot of these costs. If those costs are still there,
yeah.
Even if data's not there, Well, again, you're ignoring the intercompany stuff there. I mean, when you do your analysis, how close are we to breaking even? Can we break even? How much of those costs are actually relevant to this decision? If that makes any sense. So I think if you answer my question two, and you look at fixed and variable cost, then you look at break even and you look at the alternatives that could happen, then you go, well, is it really, it helps you do two things. Looking at cost behavior and which costs are relevant to the decision and which are not may lead to a different, you may say, hey, it's a problem, and then say, hey, it's really not as big of a problem. Or you may go vice versa. Then you start looking at all these alternative solutions, and you're sitting in a meeting and somebody goes, hey, increase the price. Yeah, that'll help us earn more. You're like, yeah, but what's the actual net effect? Well, that's what question 3 does. Somebody comes up with a solution. You should be able to run some quick numbers and at least get an estimate of how, is this a good move or a bad move? And so that's really what question 3 is trying to address. Then we come back to the very last question that we have, and then you come back to, my last question in that whole thing, and you get back to that one and say, okay, well, look, is there an easier way? It looks like there may be some misunderstanding if data is doing good or bad. Is there some other way that we can come up with this? And then the answer may just simply be, and again, my question is almost the same, is there anything that we can do to make the information more useful? And it may be that, we've got fixed cost here. We've got variable cost here. Maybe I can isolate the relevant costs. Maybe I can isolate the ones that are not relevant. Maybe I can restructure the income statement in a way that is different from the way that the income statement looks, as it was given in the case and the way we've always talked about it. Because you got to remember, with Lecture 6, we're into managerial accounting.
We can do whatever we want when it comes to reporting.
Yeah, managerial accounting is not bound by GAAP.
Yep.
If I'm a manager and I'm going, well, look, I see all my revenues, I see all my expenses, but I want expenses broke down into fixed and variable expenses. Well, if that's an answer that helps you understand what is better or not, or like you're fixed to the parent or not, if that's something that helps me understand it better, then demand the report that way. Because this isn't going to anybody external. This doesn't go into, so I can demand the information presented in a way that's going to make the most sense to me. Now, the issue is, does your accounting system track that? If it doesn't, and it's helpful to you to make decisions, well, maybe it needs to start tracking that. But as a manager, you can always ask for whatever information you want to ask, because you need it to make a decision. The accountant should be able to provide you information that makes a decision. And so I'm asking there. So what I think you'll do, if you'll answer question, my question 2, my question 3, maybe by then you circle back around and your answer to 1 may or may not change, or your reasoning as to why it's really a problem you may end up going, you know what, I initially thought it was a problem, but it may not be as big a problem as I thought because. Or you may say, hey, I didn't think it was that big of a problem, but now looking at their cost structure, it's actually a bigger problem than I thought because. But again, question 1, I'm really looking for the why, and the why may feed off answers 2 and 3.
Yep, got it. Okay. I think I'm good on this. I think we've lost a couple people. Anybody else have anything for Dr. Jones tonight?
I'm sure we'll have more questions once we dig into this one tomorrow. But I'm kind of like TJ. I was looking at those other questions. These questions are brand new to me.
Yeah, no, absolutely. Look, I'm glad, and that's why I'm glad you're doing this. Thanks so much for doing it. But yeah, when you're looking at this, definitely we need to make sure that we look at the ones in the case. And I think I'm gonna try to go back to Canvas here. I think
I'll text everybody on our little WhatsApp.
Oh yeah.
So.
But that'd be helpful, and I'll post an announcement on that. I meant to do that, but honestly, it just completely slipped my mind because Dakota is fine. It's like when you click on Dakota, I do. Well, I'll say this on Dakota, I do is the same way. If you look at, like, I've just clicked on that, Dakota Office Products, please use these questions in lieu of the questions in the case. And if you look there, what I've done with Dakota, I've actually attached, I know that's off a ways, but just to let you know, when you look at Dakota, I actually provide you in the module. I'm checking that again. I need to probably make that. I'm definitely going to make those more clear in my announcement. But I actually provide you in Dakota. I do something very, very similar there. I will be providing you an attachment because we're going to be talking about a costing system. And instead of you designing the costing system, I give you a system that I want you to critique, and then I'm like, okay, critique it, then use it. So I'm going to do a similar. So what I did with Prestige, I'm going to do a very similar thing with Dakota.
Okay.
So for the next couple of cases, make sure you pay attention to the ones on Canvas, not the ones on the thing. So again, if you can do that in WhatsApp, that'd be great. I'll do that in the Canvas, and that'll hopefully be clear to everybody.
Perfect. All right. Anybody else have anything? No? All right, Dr. Jones, I appreciate your time tonight.
Yeah, no problem. Thanks for setting this up.
All right, Eric Travis, we'll talk to you soon, okay?
Yeah.
All right. Thank you. Have a good night.
Bye,
Bye,
guys.
guys.
Thanks a lot.